Okay, welcome back to everybody's favorite Finance 301. So when we left things off, we were in Chapter 15a, starting to do entity valuation, specifically for shareholders. And what I'd like to do in this video is finish up the chapter here, and I'd like to look at Part 2, valuing an entity in a buy, manage, sell situation. So let's do a little bit of review and pick it up from there. So when we're doing a buy, manage, sell operation, we have three pieces. So piece number one right here is the purchase piece. And then here we have the manage piece where we're going to enjoy free cash flows from the entity's operations. And of course, those need to be discounted back to t=0. And then the third and final piece in this case is the sell piece where we're going to sell 100% of the shares and walk away. And of course, that needs to be discounted back to t=0 as well. Why? Because as usual, we're doing an NPV evaluation of this project. So we looked at how to compute the free cash flows from operations, and we went through a bunch of stuff. But at the end of the day, the cash flow from operations is going to simplify to net income. And we're going to be dealing with steady state companies. Even though we're not going to be owning them forever, we're still going to be considering steady state companies. So the free cash flow to owners for as long as we own the firm is going to work out to be net income. And the sale price typically comes from some estimated net income at the time of the sale times some estimated PE ratio at the time of the sale. We talked a little bit about taxes, but what I really want to jump into here is our example. So we've got a new company that we talked about a bit in class called Supercontainers Inc. And it was a decent company operating fairly well. We got some information on its loan, its interest rate on its loan, and its tax rate, all that sort of stuff. And the current market conditions, we talked about the slump for the market for purchasing this type of firm, but nonetheless, Supercontainers itself doing really well at this time. And Supercontainers should be out of the current market slump, Max Value believes, in 2 years. So here's the strategy for Max Value. If they go ahead with this project, they'll buy all the equity today for the asking price of $120 million. That would be to buy, of course, 100% of the shares. And the firm feels that SCI is optimally capitalized, has the right amount of debt and equity to maximize ROE for the owners while not having too much risk of bankruptcy. So like we said, they're going to, if they go through with this, operate the firm for 2 years when they expect the market to have recovered, and then they will sell the firm for a price that they believe will be up from $120 million all the way to $160 million. And as usual, we are going to be helping out with this as interns in the company. So our managing director has given us some information. So we've got the pre-tax cost of debt here. This is pre-tax at 8%. That's the interest rate on the existing loan. And someone has computed for us the equity cost of capital. And like we said, the income tax rate is 35%. And we're going to see if we can help Max Value find out if this would be an NPV positive project for them as envisioned. Okay, so step number one is we're going to have to get all of the cash flows we estimate for this project so we can put them into the NPV equation. And as usual, piece of PE is the purchase price paid by the new owners to get 100% of the shares. And the free cash flow is going to be the net income for 2 years. The free cash flow for a steady state company to shareholders works out to be net income. And then the third piece is the sales proceeds, which we know is $160 million. So let's go through it. So the purchase price, the asking price is $120 million, and that will get Max Value 100% of the stock. And then the free cash flows from managing the firm in general, they come from this equation from accounting, from our indirect cash flow statement. But since the firm is operating in steady state, this works out. We have all our assumptions here. So the free cash flow in any year I is just FCF. They're all the same in every year, and they're going to be equal to net income. And we saw how that worked out. Everything else in this equation for free cash flow drops out if we have a steady state firm. Okay, so we've got here to look on our income statement to see that the net income steady state firm has been 15.3 million. So we'll continue to be 15.3 million. So it's net income and it's 15.34, let's say, million. And again, for you accounting majors out there, you can actually see how this works in indirect cash flow statement form. We always start with net income, subtract changes in working capital, which are 0 for a steady state firm, add back depreciation from the income statement, and subtract CapEx, which is going to match depreciation for a steady state firm. Steady state firm, no changes in the debt. That would be cash flow from financing. So once again, we do get the free cash flow to equity is 15.34, which equals the net income. okay, the sales proceeds at end of year 260, that's estimated by someone else at max value. So now we're ready to apply our NPV equation and evaluate what's going on here. So let's see if we can do this together. All right, so we have minus 120 plus, we're going to have, what is it, 15.34, I think? Yep, 15.34, 15.34 divided by 1 plus, I'm going to have to go back with a mind like a steel colander. I'm going to have to go back and look up what our equity cost of capital is here. So back we go, whoops. And let's see, I went past it. It is here somewhere. There we go. It is 10.31%. So we'll put that in. Okay, 1 plus 10.31%. And that's going to be raised to the 1. That's the first free cash flow that max value would enjoy at the end of the first year they own the firm. And then they're going to get the same thing, 15.34 divided by 1 plus 10.31% raised to the 2. Okay, and then we have to add now our SP term here. So I've got a plus sign there already. I'll just leave that there for us. And they believe they're going to get 160, and we have to discount that back to t equals 0. So that's also back to 1 plus 10.31% raised to the 2. And let's put this into our electric calculator or pencil over here. So let's see what we can do over here. And I still have to add that last term, that 160 divided by 1 plus 10.31% raised to the 2. Blammo. Okay, and we get 38 million. Okay, so the NPV in this case is clearly greater than 0. So the model, if we believe all these assumptions and etc., says go for it. Okay. All right, so it's that straightforward. So now we have 2 types of models for equity evaluation for owners. We have a perpetuity situation, the simple dividend discount situation, where we say the firm remains in steady state forever. We own it forever. We enjoy the free cash flows forever, and we just use the perpetuity equation. And the second case that we've just gone through is our buy, manage, sell case, where we have the 3 pieces. And again, even in this case, we're assuming that the firm, for the time period that we own it, is going to be in steady state, which simplifies what our free cash flows from operations are going to be quite a bit. Okay, and then let's think a little bit about how max value estimated that future sale price of 160. So what they did is they tried to estimate what the net income would be at the time of the sale, and the PE ratio for firms like this at the time of the sale, remember, after they believe that the market will have corrected from its current slump. So the net income is going to be unchanged in this case, because the firm is in steady state. The net income is never changing, but the market conditions are going to change, and that should raise the PE of the firm in 2 years. So let's see what they did. Okay, so they note that these PE ratios fluctuate with market conditions, and they computed the PE in the current bad market conditions as 7.82. And then what they did is they looked up historical PEs of comps in a good market. This is something that investment banks do, and they have a database of this kind of stuff. So they take the average of the comps in a good market, and they got a PE ratio on average of a good firm like this in a good market, PE ratio of 10.43, and they assume SCI's PE ratio will converge to that. So now they've got everything they need. So they take the estimated net income in year 2, unchanged for a steady state firm, times the estimated PE ratio of 10.43, and that's where they get their 160 that they believe they can sell the firm for in 2 years. All right, the rest of the chapter is appendices, so I'm going to leave those to be perused by the accounting majors in all of their free time. So till we get to chapter 15b, I'll leave you to your own devices and look forward to catching up again soon. Take care.